Hey team, we got a great video here that walks us through an equity method simulation. So great job for watching it. If you practice the simulation, even better. Now, what are we going to do in the video? We're going to start by breaking down the instructions. We have to know what we need to do, right? Then we're going to quickly review the exhibits. Now, not in extreme detail, but the exam, they do put some key information in these exhibits. So it's helpful to read them before we start the simulation to understand, okay, what's the big picture? And then we're going to attack the simulation. I want you to think about Game of Thrones. We're on a horse, we're a knight, we're riding in to attack this simulation, and we will win. Am I right? So let's go through and nail this. So here we are, it's January 1st, year 5, and Stream Corp, they purchased outstanding common stock of Anderson Corp. So we know the common stock is a type of equity security, but we don't have enough information yet to determine, are we going to use the fair value method, are we going to use the equity method, or are we going to use the consolidation method? Now it tells us additional information can be found in the exhibits. Of course, right? All this information is going to be scattered. They also tell us that they prepare their financial statements with a calendar year end of December 31st, year 5. Now, as the controller for Stream, we are responsible for recording the journal entries that are in this simulation. Right? So we'll get to those in a bit, but first off, we need to look through the exhibits to learn more about this simulation. So our first exhibit is an email from the Stream CFO to us as controller. And they're just going to tell us some information about this investment in Anderson. So it starts off by telling us they purchased 4,000 shares. Doesn't mean a lot yet. They tell us it's a long-term investment and it represents a 30% ownership stake in Anderson. Well, 30%, that's above 20%. It's below 50%. So it's right in that range to be an equity method investment. Does significant influence exist? That's the question we should be thinking about. And that's where we need to keep reading, because it says that as part of this investment, well, they must have negotiated 2 board seats. And so now with these 2 seats on the board of directors, the team or the investors of Stream, they can control the strategic operations and the financial decisions of Anderson, right? Because Anderson, it says they rely on the technology of Stream. So basically Stream is like, okay, let's make this investment so that not only we can grow this company, but we can also advise them strategically and financially. So that sounds a lot like significant influence. So we combine that with that 30% ownership stake, we can go ahead and say, okay, under US GAAP, we need to account for this investment in Anderson using the equity method. Now it tells us our purchase price was $150 per share of common stock, right? So think about that relative to the 4,000 shares. That's going to be our purchase price. But then we also need to think about, are there direct acquisition expenses? And it says they incurred $50,000, right? So we'll come to that when we go through our steps. The next paragraph says we engaged Goodman Thomas to perform a valuation report of Anderson on the acquisition date. So we should be looking for another exhibit that talks about the comparison of the fair value and the book value of the net identifiable assets. We need to see, okay, were there any differences? Because we will need to account for those differences when we record our journal entries for the equity method. We should be thinking about that amortization premium. And then, as you might expect, the CFO is requiring us as the controller to record the journal entries. Now, we might have a team to work with, but ultimately, we record the journal entries. The CFO will approve, right? So that's the email from the Stream CFO. The next exhibit is an email from the CFO at Anderson, and it provides some financial info. Now remember, there are cases where you could make a significant investment that would apply the equity method, but if we don't get the financial information that we need, then it's going to be pretty hard, because remember, we need to get some net income information. We already talked about we needed to get some information about the book value and fair value of their net identifiable assets, but maybe they can't get that. So anyway, the CFO at Anderson, they say, okay, as a significant investor, well, we get specific financial information. So that's great. It says for year 5, we generated net income of $340,000 on revenue of $1.2 million. So that net income figure of $340,000, that's going to be key, because we need to base our percentage ownership and reflect that in our journal entry. Now it tells us some other information about the operations, like net income as a percentage of revenue. That's great. It improved. They talk about why the margin improved. Then it talks about in year 6, how they plan to expand. All great information, but not necessary for the journal entries. But there is one more piece here. It says they distributed a dividend of $15,000 to the shareholders of common stock. Now remember, we treat dividends under the equity method as basically a liquidating dividend. So it's going to reduce our carrying amount. So we'll need to take our percentage share ownership in that as well. So 2 key pieces of information come from that exhibit. It's the net income of $340,000 as well as that dividend. All right, so this next exhibit is the Goodman-Thomas valuation report regarding Anderson Corp on the acquisition date. And in this summary, we can see that we basically have the net identifiable assets broken out between assets and liabilities. Then we have the book value and fair value. And we're really focused on that difference column. Because remember, if there's a difference, we need to amortize the premium based on our percentage ownership over the remaining useful life of whatever's contributing to that difference. So remember, again, this is for 100% of Anderson. When we actually do the calculations, we only care about our percentage ownership, which is 30%. Now, if we look below, the main driver of that $80,000 difference is due to autos. And it says the fair value is $180,000 versus the book value of $100,000. So that $80,000, again at 100%, well, that's what we need to basically consider as the amortization premium. And we're going to divide that by the useful life of 4 years remaining, right? So that's important information. We'll get to that when we get to that step. And then the last exhibit here is just the Anderson Corporation income statement for year 4 and year 5. If that email from the CFO did not tell us the net income amount of $340,000, then this would have been crucial, but all this does is support what we already knew, right? So look for that on the exam. They might keep it in a separate exhibit and give you the income statement, but here they provided the net income as part of the email. So they made it a little easier for us. So now we're ready to attack the actual journal entries. So let's dive into them. The first one says journal entry to record the initial investment in Anderson on January 1st, year 5. All right, so we should be thinking about what was the purchase price per share and were there any direct acquisition expenses? Well, remember from the exhibit with the email from the Stream CFO, it says they purchased 4,000 shares at $150 per share. So we need that information. We also care about those direct acquisition expenses of $50,000, as those will be included in our investment in investee on the balance sheet, right? So as you can see in step 1, right, thinking back to our mental map, well, the purchase price, that's the 4,000 shares at $150 per share. That equals $600,000. Add in those direct acquisition fees of $50,000, and that means the total investment in investee is $650,000. So for our journal entry in the simulation, we would debit investment in investee, which is the investment asset account on the balance sheet, for $650,000, and then we would credit cash for $650,000 for that outflow relating to the purchase of the Anderson stock, right? So that's very straightforward, but that's a great starting point that we need to understand. Our next task is to record the journal entry related to the share of net income or net loss for Anderson during year 5. Well, if we think back to the email from the Anderson CFO, right, it shows net income for year 5 that Anderson reported at 100% was $340,000. Now this is key. We do not base it on that $340,000 because that's 100% of Anderson, and we as Stream only own 30%. So all we need to do to record our share of net income would take the net income of Anderson, which is $340,000, multiplied by our ownership percentage of 30%. That means our share is $102,000. Right? So that's going to increase the carrying value of the investment on the balance sheet, and we would also record basically this profit or gain or income from the investment in our income statement. And we would do that by debiting investment and investee for $102,000 and then crediting equity and investee income for $102,000 as well, right? So that's what we would plug in to the journal entry. But remember, it increases the carrying value and it also records basically an increase to net income in our income statement. Our next task is to record the journal entry for our share of the dividend paid by Anderson during year 5. So going back to that exhibit with the email from the Anderson CFO, it says that the board of directors basically said, okay, you guys can pay out $15,000 of dividends based on the current year earnings. Well, we only own 30% as stream, so that's all we care about is 30% of 15,000. So 15,000 times 30%, that means the share of the dividend for stream would be 4,500. Now they're receiving a cash dividend, so we would debit cash for 4,500. Now, unlike the fair value method where we would record dividend income in the income statement, we treat this as basically a liquidating dividend or a return of capital. So we'll go ahead and credit investment and investee for $4,500. That's going to reduce the carrying value of the investment on the balance sheet. Right? So that's the journal entry to record our share of the dividend. Now, step 4, like I said in the lecture, is arguably the hardest step. But if we think about the few key things we need to know, then it's not too bad, right? So we're really focused on, is there a difference between the fair value and the book value of the net identifiable assets? Well, remember the Goodman-Thomas valuation report? It basically showed that there was an $80,000 difference between the fair value of the fixed assets or the PP&E and then the net book value. And remember, it was attributable to autos. Now, when we look back at that report, we see it's at 100% of Anderson. And again, we really need to remember that it's based on our 30% ownership. So if we take 30% of the fair value of net identifiable assets, which was 1.5 million, well, that equals 450,000. And then the book value, if we do the same math, right, 1,420,000 times 30%, that equals 426,000. So based on our 30% ownership, there's a premium to amortize a 24,000. Now, since it's specifically related to the auto, which has a remaining useful life of 4 years, then we divide that 24,000 by 4, and that means the amount to amortize in the current year and for the 3 subsequent years will be $6,000. So the journal entry, well, the debit is to equity and investee income. Now, this is basically reducing the income we already recorded related to our share of the net income. Right? We're not impacting amortization expense. This is a very common mistake. It sounds like amortized premium, and like for intangible assets, we would debit amortization expense, but that's not the case here. We're basically just reducing the equity and investee income we recorded in step 2 related to net income. And then the offsetting credit, well, we're reducing the carrying value. We're trying to bring down that fair value over time back to that book value. So we'll credit investment and investee for $6,000. So that's a difficult journal entry, but after those few steps, right, you see how simple it is, and those are going to be super repeatable. There's a few other things we talked about in the lecture, so let's see how they're applicable here. So one thing is goodwill. Remember, goodwill, we do not record any journal entries. It's not going on the balance sheet, but we do need to understand whether goodwill exists because it's just something that we need to know, right? So remember, it's just the purchase price, which was $600,000 minus our share of the fair value of net identifiable assets, which was $450,000. We just talked about that in step 4. So that means goodwill is $150,000. Now, how can we break down the purchase price to understand this? Well, remember our purchase price again was $600,000. Well, we purchased a book value of net identifiable assets of $426,000. And then basically that excess amount to get up to fair value was $24,000. So that takes us up to $450,000. And then goodwill was the remaining $150,000, right? So basically, if we had to break down the purchase price, well, $150,000 went to basically some amount of goodwill, which is really hard to identify. $24,000 relates to the excess fair value over the book value that Andersen had, and then the rest of it's just the book value of their net identifiable assets. So hopefully that makes sense, but that's how you can break down the purchase price. And then I also want to summarize the financial statement impact for both the income statement and the balance sheet. So for year 5 for the income statement, well, there's two things that impact net income. It's going to be the share of earnings, or the share of net income, which we determined was $102,000, but then it's offset by the amortization of that premium related to the difference in the fair value and net book value of net identifiable assets. And for each year, that was $6,000, right? So that means our net impact to net income for year 5 was $96,000. Now for the balance sheet, as of December 31st, year 5, what was our ending investment in investee? Well, our beginning investment in investee based on that initial journal entry was $650,000, right? That's the purchase price plus those direct acquisition expenses. And then we add in our share of net income, which was $102,000. We subtract out the share of the dividend received, which was $4,500. And then we also have that amortization on the premium for the net assets of $6,000. So that means our ending investment in investee as of December 31st, year 5, would be $741,500, right? So that's the full picture of the equity method. Again, review this. There is an Excel calculation file in the text explanation that you can download. I highly recommend that. You can see how all of this is connected. You can use the file for other equity method questions, but it's going to help see exactly how a controller would look at this information when they're actually doing this type of work in the real world, which is exactly the thought process you need to bring for the exam.